Welcome to this explainer, where we take these massive, complex, and honestly kind of intimidating systems, and we just break them down into clear, visual pieces. Today, we're taking a look at the economy. Now, I know it can completely feel like this chaotic mess of numbers, stress, and never-ending bills. But really, it's just a game. A highly complex game for sure, but a game with rules nonetheless. And let's be real.
Here's our roadmap. We've synthesized this whole chaotic world of finance into 5 digestible buckets. 1. The illusion of money. 2. Middlemen and the Taxman. 3. Invisible wealth eaters. 4. Your scorecard. And finally, number 5, how to build wealth.
All right, picture this for a second. You just had a seriously grueling month at work. You've been slaving away, let's say flipping burgers at McDonald's. You get a notification that you've been paid $2,000 for all that hard work. Awesome, right? But then you actually check your bank account and you only see $1,456. Ouch. This is basically the modern ritual of giving away a massive chunk of your money to the invisible forces of the system. And the kicker is, they expect you to say thank you. So where exactly did it all go? Why does the system actually work this way? Let's start with part 1, the illusion of money, questioning value. Okay, here is the absolute wildest secret about finance. Money isn't actually real. I know, it sounds crazy, but it is entirely a social construct built completely on shared belief and trust. Money holds legitimacy literally only because society collectively agrees it does. Think about it. There is no fundamental scientific difference in legitimacy between a dollar bill and a random stick on the ground. The only reason a dollar bill can buy you a nice dinner and a stick cannot is just that we've all agreed the dollar has value. We humans developed this concept to make trading easier, to organize society. But because it's just a construct, it has to be regulated. So the government prints it and central banks regulate it to make absolutely sure they don't print so much that it turns into monopoly money or print so little that nobody can actually live. Moving on to part 2, middlemen and the taxman, taking their cut. Now, what's really interesting about this is, if we go back to that $1,456 paycheck, that missing difference went directly to taxes. And taxes are fundamentally the cost of civilization. You pay the government, and in return, they build the roads, they fund the schools, and they make sure your favorite taco truck isn't totally infested with rats. The government takes a little bit of every single dollar through a bunch of different channels. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax, that hits the money your investments make while you're sleeping. Then there's Social Security, which is essentially the government forcing you to save for retirement right now so they can pay it back to you later. Plus Medicare, which is a health insurance tax to support the elderly or seriously ill. And honestly, the most bizarre part of this whole shebang, when it comes to filing income taxes, the government already knows exactly what you owe, but they make you guess. If you're right, great, but if you get it wrong, you are absolutely cooked. So after the taxman takes his cut, you take whatever's left over to the bank. Now, most people imagine banks as these giant impenetrable vaults guarded by dragons, where your specific cash just sits in a little box and waits for you. Let's shatter that myth right now. Banks are just middlemen. They're matchmakers. When you deposit $1,000, the bank might keep, say, $100 on hand and then immediately lend the other $900 out to someone who wants to buy a jet ski. This system is called fractional reserve banking. They only keep a tiny fraction of the cash because they know for a fact that not everyone is going to ask for their money at the exact same time, unless, of course, a massive 2008-style panic hits and the whole system crumbles. But generally speaking, it works. Plus, your deposits are insured up to $250,000 by the government. The bank literally pays you interest to hold your cash simply because you are their supply line. Which brings us to part 3, invisible wealth eaters, the silent thieves. So imagine you go to the store to buy your absolute favorite bag of chips. You open it up, it looks half empty, and then it hits you. You literally paid 30% more for it than you did just last year. Your $5 bill is still technically a $5 bill, right? But suddenly it buys fewer instant noodles and a whole lot less gas. This is inflation. But what actually causes this to happen? Inflation is basically this slow, quiet erosion of your money's value, and it happens for a few key reasons. First off, sometimes there's just way too much money chasing way too few goods. If 2,000 people want to buy a $500 TV, but the store only has 1,000 of them in stock, well, the store is just going to raise the price to $800. Second, supply chain hiccups make producing goods a lot more expensive, so those extra costs just get passed right down to you. And third, this one is wild. Consumer expectations. If people expect prices to rise, they rush out to buy things right now, which ironically drives the prices up even faster. It's a complete self-fulfilling prophecy. Now, a steady, predictable 2% inflation is totally fine, but when it spikes, wages lag way behind and your savings just get eaten alive. To fight this, the government steps in and raises interest rates, which makes borrowing expensive, and that eventually cools down all that spending. So let's see how this builds into our next massive macroeconomic threat. Because when the government cools off the economy too much, or a sudden crisis hits, the entire economy shrinks. Jobs vanish out of nowhere, companies drastically cut costs, and growth just halts entirely.
We call this a recession. But why exactly does this sudden vanishing act happen in the first place? Think of the whole economic cycle like a giant party. During the boom phase, everyone is dancing, the drinks are flowing, people are spending money left and right, and jobs are super plentiful. But eventually, we hit a peak. Maybe interest rates get a bit too high, making borrowing way too expensive, or a global crisis hits, like, say, a pandemic or a massive container ship getting stuck in a canal. Then comes the bust. The lights flicker on, reality hits, someone checks their bank account, and suddenly the DJ is playing sad lo-fi beats about corporate downsizing. That is the recession. But here is the absolute crucial takeaway for you. Recessions aren't forever. They're not. They are just painful resets. Eventually, the government lowers rates or sends out stimulus checks. People slowly start buying overpriced coffee again, and the party rebuilds. All right, part 4, your scorecard, the credit game. So, your credit score. It's basically this shadowy algorithm that knows your name, your past, and exactly how many times you paid your credit card late back in college. It literally decides whether you get to buy a house, a car, or if you're stuck with a soul-crushing 27% interest rate on a new TV. The absolutely crucial point here is that this number is not about your wealth, not at all. It is entirely about your trustworthiness to lenders. They literally just want to know one thing. If I give this person money, will they pay me back? The highest impact on this score comes from your payment history, simply paying on time before that late period hits. Next up is credit utilization, which is basically how much credit you're currently using versus what you actually have available. And that's followed by the age of your accounts, the mix of your loans, and how often you apply for brand new credit. Now, 750 plus. This is the target. A credit score ranges from 300 to 850. If you are sitting anywhere below a 580 to a bank, you are a walking red flag. No way around it. But if you can cross that magic 750 threshold, you are suddenly sparkling with adult credibility. This grants you the lowest possible interest rates, which, no joke, will save you tens of thousands of dollars over your lifetime. I absolutely love this analogy from our source material. Your credit score really is exactly like a pet dog. If you take good care of it, someday it will help you buy a house. But if you ignore it, it just poops all over your life. Because it's not about actually being good with your money. It's just about looking good to the lenders. You could literally have zero debt and a mountain of cash in the bank. But if you have no credit history, you'll still have a trash score. Yeah, the game is totally rigged. But if you learn these rules, you can absolutely rig it right back in your favor. And this brilliantly illustrates the engine driving your credit and your wealth. Interest. It is essentially money's way of charging rent. When you borrow, it's the price tag. But when you lend or save, it's the reward. There are two main types here. Simple interest is just a flat fee. Thanks for playing, right? But compound interest, that is when the dollars I gave you create clones of themselves, and then those clones also demand rent. Now, interest is a huge double-edged sword. At 20% on a credit card, compound interest means your missed payment earns interest on itself, turning a tiny $12 burrito into a $50 regret. But investing at 7% compound interest, that's a literal cheat code. Your money just duplicates. Which leads us perfectly into part 5, how to build wealth, winning the game. To actively combat inflation and stop your money from slowly eroding away, you have to invest. Investing is simply what happens when your money stops sitting around on the couch and starts actually working for you. You stop trading your limited time for dollars, and you start trading money for more money. You can put it into stocks, which are just tiny ownership slices of actual companies, or bonds, where you're essentially loaning your money to governments or companies for a guaranteed return, or funds, which just bundle all these together so you don't even have to pick and choose, or real estate, where someone else is paying to live in your property. Yes, of course, there's risk involved. Markets go up, markets go down. But let me tell you, the real danger isn't the market taking a dip. The real danger is never investing at all and letting inflation just quietly steal your future. Now, to really accelerate this whole process, you need to deeply understand where wealth actually comes from. It comes from value. Imagine a rock. It's just a rock, right? Now imagine that exact same rock is shiny and yellow. Bam, it's gold. Gold isn't inherently worth more than a regular old rock. It's just rarer, and we humans perceive it to have a higher value. This concept is literally everything. Steve Jobs created the iPhone, providing massive perceived value to millions of people who gladly handed over thousands of dollars for it. It's the exact same reason a Gucci handbag sells for 100 times the price of a Target handbag, even if they're holding the exact same keys and wallet. People perceive it as more valuable. If you can figure out how to create real value for others in your own career or your business, you will earn the capital you need to play the investment game. But please, do not fall for the trap of the overnight success. It's an illusion. Investing isn't about being lucky. It's about being early, being diversified, and being incredibly patient. The wealthiest people in the world didn't just win the lottery. They simply took consistent compound growth and gave it 30 years to work its magic. Little by little, year by year, the clones just made more clones. Which brings us to the ultimate cheat code in this entire financial game: time. Time is arguably the most valuable asset in the world, and almost everyone starts out with a lot of it. The top earners out there don't have magic on their side. They just use leverage and train their hours to work for them.
Time is multiplying your money right now, as we speak. Compound interest is happening, whether it's through the slow, painful burn of debt or the massive, exciting wins of an investment. So the only question I have to leave you with today is this. Is time working for you, or is it working against you? Thank you so much for joining me in this explainer. Keep learning the rules, keep mastering the game, and I will see you next time.